So everyone, this is Tyler. He's my business partner on this with investing in developing self-storage. So I'm going to jump into the presentation now because he is the resource to answer the more detailed questions when we get into it. So basically, the brokerage, as you all know, we've helped over 1,500 people from across Canada invest in real estate. And myself, owner and broker record Remax Wealth with Real Estate, been selling real estate for 17 years. In 2022 as number one Remax agent in Canada. 2024 is number two. I'm sorry I slacked last year. But as an individual, I'm inducted into the Hall of Fame. Lifetime Achievement Award at 35, Remax Circle Legend Award at 40. Recently received the Pinnacle Award, but I've turned a deposit from 39,000 into $20 million. And then with Tyler, part of my portfolio is with him as well. And we'll be able to talk into depth why we both pivoted to investing in self-storage. So he was in development of multifamily residential in the Hamilton area. As you've all known, I've been investing in condos. Here's the majority of the portfolio here. It's not everything. I recently bought 3 more properties in Calgary. Also have my my office building as well. But why I showcase this is normally when I showcase this to people, I show this to my portfolio. I invest in real estate, and real estate's all about buying and holding over a long period of time. Here I'm showing $17 million current value of the portfolio. I did some rough math, and this is what we're going to get into. That is not 17 million right now. That's probably about 15 million right now with the drop in values in my condos. But the beauty is, as long as you hold real estate and you hold it over time, it all comes back. And in 30 years, my portfolio will be worth $42 million. And that will be, there's mortgages obviously on that 17. But in 42, all those properties will be paid off. That is how Tyler and I lived in the past. And that's what we looked at. So I built this and secured my retirement. Tyler, did you secure retirement investing in multi-residential real estate?
The loaded question, but I think I've secured a solid retirement.
Yeah. And you left corporate world at around 30 years old because
Yeah,
you had replaced your income enough to
yeah,
start developing in multi-res.
yeah, exactly. Yeah, I always said when the cash flow from my real estate portfolio got close to what I was earning, I'll call it the lifestyle that I was living through a corporate income, I'd, you know, take the water wings off, so to speak, and jump and really believe in myself. And yeah, I did that about 10 years ago.
So we both did that, but we did that in our 30s. Then something happened. And the issues with this model today is properties are when you're investing in residential properties are cash flow negative, 20% down, and rents are falling. Properties purchased pre-construction have come in with negative appraisals. Challenge. So I showed you all those properties. There's challenges securing multiple mortgages. Tyler and I have gotten every single mortgage that you can think of. We played in every single field. We know how to do those things. But that requires a lot of energy to do that and a lot of stress. And there's the dealing with the ongoing requirements of the tenants. Um, if I ask Tyler about this, he may start swearing about his thoughts about the landlord and tenant board, because predominantly his development was all in Hamilton, and he had a lot of hearings uh, with the landlord and tenant board. Heck, there were wanted signs with his picture on signposts in Hamilton with tenants saying that they were coming after him. So this was all dealing with the landlord and tenant board and dealing with residential properties. Our retirement was secure, but our what happened from our 30s to our 40s, and our kids are the exact same age. Um, our lifestyle changed. So what we were able to do in our 30s, we weren't able to do in our 40s. So the difference between Alex at 33 versus 43, I was single, I wasn't married. I had no kids. Now I have 3 kids under 8, and I no longer have the luxury of time and the capacity for headaches. That's truly what it is. When I was looking at that portfolio, I built all this portfolio. But when you look at all the different headaches that come with it, I'm like, there has to be a better way to invest. Now, I did that investing. It secured the retirement. It secured investment income. but I didn't want to make money the way I made it in the old days. And frankly, you're not able to make money the way we did in the old days today. That doesn't exist anymore. The pre-construction properties that I bought in 2012 for $250,000, those opportunities don't exist today. You can't make money in the pre-construction way like we did. So my dependence equal, I no longer have the same risk tolerance or luxury time and mental capacity to deal with these things. I don't. And Tyler doesn't either. I know that for a fact. And that's not a life that he wanted to live anymore, dealing with tenants and properties and all the issues that came with that. And what it is too, and especially right now, if you look at it with government intervention, when you play with residential real estate in Ontario, and I'm not worried about the values of my portfolios. And I know they're like some of the best opportunities I see is in resale condos in downtown Toronto, but there's different headaches that come with that. But you're dealing with a government controlled resource. And I can point where there were times when my portfolio went down in value because there was government intervention. And we're dealing in an age where we're going to see more government intervention. And that's going to impact how we do things in real estate. Uh, but there had to be a better way. And so what ate into my time and capacity? Well, mortgages. I have to send literally. And I looked at the attendee list, and some of you will say, like, oh, praise be, yes, exactly. We have to send over 200 documents to apply for one mortgage. Tyler, I know Tyler's in the exact same boat because he's dealing with a pre-construction property. He's closing right now, and he's probably sent over 200 documents to the lender that he's dealing with. I know the lender he's dealing with. It's literally over 200 documents. And here, back in the day when I had other partners that I bought real estate with, and they were older, they were in their 50s and 60s. I always wondered why they got so angry at banks. Because they'd be like, why does the bank need this for me? Why does the bank need that for me? I have the money. As I got older and as my time and capacity got eaten up, I got so annoyed with all the questions that banks ask me. I'm like, I have it. Here's what it is. But they have their checks and boxes. And in today's environment, it's harder to get mortgages today than it was 10 years ago. And I'll throw it back to Tyler. Tyler, when you were investing, when you first started investing, you could get 40-year amortization mortgages with 0% down. There was a brief
Yeah,
period.
there
Do you
was.
remember that?
No, I do. Yeah.
Yeah. And it was easy to get mortgages then, wasn't it?
Yeah, it was extremely easy. And then it went obviously to 5%, and we thought the sky was falling. And obviously you adapt. And yeah, now it's, now the ironic part is, and I'm sure, some people on the line, depending on their experience and their size of their portfolios, candidly, I can go get a 20 or $25 million credit to, facilitate a self-storage development far easier than I can get a $300,000 credit for a personal purchase in Calgary. To use
Yes.
an
You see,
example
literally
that was
dealing
very
with that
near and
right
very
now.
recent.
Literally dealing with that right now.
Yeah.
And we and when I say we and Kyle and Nish are on this call too, we literally deal with this every day, dealing with clients. And you can get the mortgage. The mortgage will eventually happen, but the stress that you go through and the capacity it takes, you sit there going like, is this worth it?
Worth it. Yeah.
No. And then you have the falling rents, tenant vacancies, tenant requests. That all takes up capacity in the mind, and your rent does not cover expenses. Again, interest rates will continue to go down. There's a hold today, but you'll see whether it goes down this year or next year. Rates will continue to go down. But again, it takes up capacity on the mind.
Yeah, and I
When
think Alex, the thing I'll add to that is, one of the, and again, this is probably new information depending on who's the call. It might surprise some, but one of the biggest learning lessons for me in the last couple of years that we've really kind of pivoted from our traditional business, which hasn't always or has always been for the most part multifamily. But since we've pivoted to self-storage, like these projects are meaningfully larger, meaningful, much more equity. We're building facilities north of 100,000 square feet. But what the real learning lesson has been, and kind of the real aha moment, I'll call it, is that although these projects are, wildly larger, um, they are so much easier to manage and develop and navigate than honestly a duplex or a triplex or a single family conversion.
Yeah,
That's
absolutely.
been like the real aha moment is, you've got more dollars at work, you've got a larger product, You've got, candidly a sexier product, but it's easier. So it's, you touched on it earlier, everything is seasons in life, and just where I'm at with my, with my investment career, and where I'm at with, a young family, similar to you, Alex, like I want easier in my life. I don't necessarily want easy, but easier is something that I'm gravitating towards. We all know how finite time is, and I don't want to spend a lot of my time, beating my head against a wall for a $300,000 credit.
Yep. And going to that, it's because you're the developing residential, you're against government regulations. And
Yeah,
housing is a hot government regulation right now.
yeah,
And that's going to cause issues. Can you make money with it? Absolutely. If you go back to look at all my videos over the last 10 to 15 years, I say there's many different ways to make money in real estate. It just depends on which one you want to make money in. And right now, I've made a lot of money in my condo development, and we've made money in multi-res development. But right now, the pivot is getting into the self-storage side of it.
yeah.
So,
And I think on that point too, like the only thing I'll add to that, and it's just kind of further elaborating
of
on what
course,
you're saying there, like where I, again, what I've really realized, and I'll give full credit to my business partner, Greg, who was, he spent a number of years working for Canada's largest private equity company, a fund called Onyx. He was there for 7 or 8 years. And when him and I formed Malleum almost 10 years ago now, one of his everyday kind of, uh, you know, I'll say comments that he always tried to preach to me and educate me on is like, Tyler, like we want controllable variables. We want controllable outcomes. And again, like in Ontario, I know it's different than out in Alberta, but in Ontario, when, as we know, there's a lot of owners on this call, when we've got, things like property taxes and utilities and construction costs going up double digits, and we're only able, in many cases, stuff that's rent control, to increase our rent by, 1.5%. That's not a controllable variable. Our hands are tied. So again, it's to me, it's just as we've continued to learn, like I personally, especially when it's my money involved, I want to be involved in projects where there's controllable outcomes, or a lot more controllable outcomes comparatively to other asset classes. And obviously, that's one of the main reasons why we've landed on self-storage and have been so active in it.
and speaking about controllable outcomes, if let's say a tenant stops paying, the outcome of that is it could take 8 to 12 months to get that tenant out, and all the headaches that you deal with that, because you're dealing up against government regulations that don't want to take the roof over someone's head away. It's not protecting the business owner, it's not protecting the landlord, it's protecting the resident in that space. And that's not getting any better anytime soon. So you want items where you don't have to lose money on that. Now, again, are there ways to protect against this? Do I still own my residential real estate? Does Tyler still own residential real estate? Absolutely still own residential real estate, but I'm not looking to scale that side of it anymore. I'm looking at how do I leverage my existing portfolio, whether it's through sales of assets or refinancing properties, and investing more in the self-storage space. And that's going back to where my problems were: mortgages, falling rents, negative value. Oh, you didn't even talk about negative values. Negative value is closing to require more down payment to make a difference. And selling becomes a question of how much money I want to lose in that. My properties, I have properties that have gone down in value. So can I exit those? No, they're really, if I want to sell them, then I'm losing money. And again, you only lose money in real estate when you sell. So I put them in the do not sell category. I know those values will come back up. If I bought pre-construction and my appraisals are coming in below the value that I paid for it, well, then I have to come up with additional capital to make up those items, and selling more capital and impacting my rate of return on that asset. So how do I solve those problems? How do I still secure my retirement in 10 to 20 years? How do I still secure financial freedom today? So going back into this, and I know Tyler feels very passionate about this, and I feel very passionate about this. Securing financial freedom today. What I mean by that is allowing us to be mentally and physically present when we're with our kids. Like spending time with our kids is paramount to us. Like we know that time with them, especially at the young age, is finite. So we've found a way to do that. Like that's the key thing. And the problem with residential real estate right now is that's going to impact your mental capacity and your personal time. So there has to be a better way. And that's where the solution is actually developing self-storage sites with boring expected returns of 20% IRR and IRR annually. That's internal rate of return annually. So what you're doing, this solution, it solves the problem of the mortgages. It solves the problem of dealing with tenants and falling rents and negative cash flow. It solves the problem of appraisals. None of those items come into your realm when you invest like this. There's no mortgages you have to get. There's no appraisal on the property for you, and you're not dealing with a mortgage. You're just investing capital, so there's no cash flow that you're worried about on the property. So, as I said, no mortgage required, so no approval stress or negative cash flow. Tyler messaged me. Was it this week or last week? Literally he messaged me like, "Oh, Alex, do you have a good lender? You know, I have a closing coming up. I may have to extend the closing. What's it going to cost me closing it?" And I've had to do this as well. This is not putting someone on the spot. Like when you have larger portfolios, sometimes closing becomes an issue because a bank decides they don't like you anymore and they don't like the risk profile that you have with your portfolio, and they decide we're not going to give you money anymore. And again, my seasoned investors that own multiple pieces of real estate are putting in their hands going, yep, that's happened to me. Approval stress, or they're
Oh,
stressed about the negative cash flow of the property. Oh yeah, I close on it now. Now I'm spending X number of dollars per month. That takes capacity in the mind. That's taking capacity away from Tyler dealing with that. So this removes all that. No mortgages required. No appraisals required. So go ahead. With the mortgages comes the appraisal. Okay, you're qualified for the mortgage. That's great. And then the appraisal comes in 2 days before closing, and they tell you it's worth $100,000 less than what you paid, and you have to come up with another $80,000 on that. These are things that exist that I deal with every day these days. No management, no residential tenants. These are professionally managed and commercial leases. So if someone stops paying, lock goes on their storage unit, and you're not dealing with that. There's the professionally management company. You have no exposure to the management and the leases or anything and deal with that. And we'll go into more details on how that works. And then the bonus, there's a planned exit for capital return and ROI. No selling stress. So again, when you invest in residential real estate, as like, are there times that you want to sell but can't? Absolutely. And is that process stressful? So, if you were to exit a residential asset, if you call me, Alex, I want to sell my property right now. I have a 1 year lease in there. Like, well, it's really hard to sell. Or if you're like, I have a month-to-month tenant, I'm like, oh, can we get the tenant out? That'll make it easier to sell the asset. Then once we get the tenant out, that means you're getting no rent on the property, and that means you're losing money every month on the property. And you have to make all these decisions on if it's the right time to sell. Do you want to take that negative income? Are you selling the property? This eliminates all that stress, all those questions. You're not involved in any of those questions. So the partners, over 100 million in self-storage development. That's what has been done and what's coming up in the pipeline as well. This isn't something that's small, it's something that's big, and there's experience behind that. So you may all be wondering who Tyler is and why I have him on the call, other than we're alluding, but we're at the slide where I get to actually talk about Tyler. Tyler, I've known him for a very, very long time. We own real estate together as well. He's the managing partner and co-founder of Malleum Partners. He's of the crew. He's the actual developer. He's the one that's building this. There is only a reason. There's a reason why he only has an hour, because he has a meeting with the planning department right after this, with the City of London. And the background from 2017 to 2022. They've done 150 million in completed residential development in Hamilton multifamily, providing an annual IRR of 19%. So they've done this before. not only on the residential side, but also going into the self-storage side, which we're going to get into shortly. And they pivoted in the fall 2022. He called me up. He's like, Alex, I'm building self-storage. And I wrote him a check. I'm like, here you go. I didn't even ask any questions. Literally, I'm like, okay. He's like, I got the first fund. I'm like, Tyler, here's your money. We've done this before. And then he sent me a big long contract. I'm like, I'm not reading any of this. There are smarter people out there that have read this. I know this because a lot of the investors that they deal with are family offices, Wall Street, Bay Street individuals. I'm going to sign this off. There are a lot of complicated words in here that I don't want to research. And I invested with them, and now that's turned into over 100 million in self storage development. And it's really just the tipping point to something big that we see the opportunity in. Greg, his partner, he's the banker. He's partners with Tyler. But what's key is, so I put Tyler as the developer, but Greg's the money man behind it. And that is so important to have the right money man behind that. So his background was Onyx Partners in the private equity side, and he was with Credit Suisse into the investment banking division. Greg is far smarter than both Tyler and I. But what you have is you have an investment banking managing director level behind the numbers. There's a reason there's no picture from Greg, because Greg, you don't see Greg. You'll get reports from Greg. You don't see Greg. Greg is not the client-facing individual. His forte is making numbers dance beautifully. And Tyler, do you want to talk a little more about Greg as well and the genius behind him?
Yeah, he's just, at the end of the day, when I decided to partner with Greg 10 years ago, I certainly saw he had the ability to bring a skill set that was wildly different than mine. And, at that time I had been doing pretty well for myself. I have no problem saying that. That said, anybody who's been investing in real estate for a long time, like rightly or wrongly, there was a pretty good amount of wind at our back. So, um, as my portfolio started to get bigger, I started to see. I have no problem admitting this. I started to see just some holes in kind of my armor from how I was set up from a structure perspective, from a tax efficiency perspective. And that those weaknesses were really and candidly are Greg's, core competencies. So it was a natural fit at the time. Like he had worked alongside Jerry Schwartz for a number of years at Onyx. I have no problem saying he had done very well. Fortunately for him, fortunately for me, he was kind of like me. He had a young family. He was tired of, building Jerry's or helping to build Jerry's fortune and add another zero behind it. And he thought at his point in his professional career, he was ready to go out onto his own as well. And that was 10 years ago. But really, he is kind of the sophisticated private equity institutional mind that basically I've bolted on to my, I'll call it visionary project building, planning hat. And naturally, in order to be successful in this game, like you need both. I have no problem saying when I first started out, and Alex knows because candidly, he was kind of doing the same thing. Like it was, in a way, it was a wild, wild west 20 years ago. You bought, you bought, you bought. You were a little bit young, you were a little bit naive. Fortunately, it worked out very well. But again, as I got older, especially as the portfolio size grew, even more so as I started to bring in third-party capital, there really was a glaring need to become a lot more sophisticated and add a lot more sophistication to the back end of the business, the structuring side, the tax side. And again, that's candidly where Greg brings the most amount of value. And I have no problem saying, I'm a little bit biased, obviously, but I think he's one of the brightest financial minds that I've ever come across. And I'm fortunate enough to call him my business partner.
And it's so important if you're getting into raising funds, raising money, taking other people's money to invest, that you have that core financial competence working behind you. Otherwise, it would be asking for money, putting it in a bank account, and then you have questions later, and it's like you can't answer the questions. Here, you can correctly answer the questions. And then also key, is have the person that also says, hey, it's time to sell this. Hey, it's time
100%.
to refinance this. And this is the most efficient way to do this. And when you're
100%.
doing it that way, your returns exponentially go up.
Yeah, and like Greg's, again, like Greg, I have no problem saying he clearly comes at this with a private equity lens. And, when we were first started looking at Mallium, again, 10 years ago, he's saying like, Tyler, like you've done so much, you create so much value in the first, 2, 3, 4, 5 years of your ownership. And then it naturally just kind of flatlines. He's like, why aren't you selling and repatriating that capital back into another project and coming up that wonderful growth curve again? And again, like that's the typical private equity lens, right? And that's naturally the lens that we have with our Mallium legacy business, the multifamily assets, and it's certainly the lens in which we go into these sorts self-storage developments with, where it's okay, we are modeling these developments on average, usually to a 6-year hold. It usually takes a year to entitle, takes a year to build these things. And it's about a 2 to 3 year lease up to get them fully stabilized, which is usually around 90%. But then after they're stabilized, again, like we don't have to sell, so I will say that. But if there's an opportunity to sell for an attractive go forward equity return, we'll sell because we just want to basically rinse and repeat and come up that growth curve again. And it's one of the biggest opportunities that we see now within the storage space is because now since there's so much institutional capital starting to pour into the space, and candidly we're working with a couple institutions on some really large projects and some larger funds. But the one thing that I've been a little bit surprised about is that a lot of these institutions, and think large pension funds, et cetera, although they've got a lot of capital and a lot of desire to get into this asset class, like for a whole host of reasons, which I won't bore you with right now in this call, for the most part, they don't want to go through the development process.
Nope.
They want to buy built assets that are turnkey, and they want to plug them into a long-term vehicle, and they want to clip a low single digit, call it maybe not low, but like a mid to upper single digit coupon. And that's it. They are very boring style investments, but that's what they need for their pension funds. And at the same time, we know that demand and that appetite is there for built, stabilized assets, and that's kind of where our aha moment has gone off in the last few years, where we've kind of taken a step back and said, all right, if there's that demand for built product, and not a lot of people are building these, why don't we obviously capitalize on that arbitrage? And that's, candidly, that's what we believe exists right now. There's a meaningful arbitrage opportunity to build these things for, not to get too detailed, but I will right now for this comment. We're building these things for, on average, hard costs about $125 a foot. And, within the core markets, these are trading, in many cases north of $400 a foot. So there's a very large spread there that we are clearly capitalizing on. And again, whether that exists indefinitely, I don't know. The answer is probably it won't. At some point, it'll return more to the norm. But right now, with how much white space and how much opportunity exists within the major secondary markets within Canada, like we think there's at least a 5-year runway to continue to obviously fill this void, which again is one of the reasons why we're so excited about the asset class.
And to put it in perspective, they are completely out of doing multifamily. Like they still
We
own
are for now.
multifamily assets.
Yeah,
Yeah,
we are
they
for
own
now. If anything,
multifamily, but
yeah,
you're not developing any multifamily.
we're not. Like it's just like let's just be very blunt and candid. Anybody in this call, like we're probably all in this call for one reason, because we want to make money. And the reality is, you know, I have not, my business partner have not, like we have not been able to look at a residential development that we can attain any level of acceptable return based on the sheer amount of risk that we're taking to justify doing residential development at this time. If and when that changes, which again, it might, but until that thesis or until that landscape changes, I have no desire to build residential product anywhere in this country, even though we all know we need it. But my job, and like candidly, I'm I'm at the end of the day, I need to be the best possible steward for my investors' capital. My job is to go to the area of the field that shows the most, opportunity. And right now, based on everything that we know and all the other alternative asset classes that we've examined, like we continue to obviously come back to obviously self-storage for a whole host of reasons.
And so touched on the developer, touched on the banker. Then you have the operator. So the operator is the person that fills up the unit. And that's where Apple Self Storage comes in. They're one of the top five self storage companies in Canada, over 40 years in business, over 50 locations, recognized brand in the industry. So you got the person that builds it, you got the person that's doing the banking on the back end in regards to figuring out the rates of return, payouts, examining the projects, and then you got the person or the company that is then filling these units up as well. So you got the full team put together to move forward and develop these sites. That's what you want to look at. You want to look at, okay, what's my team that is going to help me get the return that they are talking about? How am I going to get to that 20% internal rate of return when they say, hey, I'm going to make 20% internal rate of return? You got to look at the back. Who's actually doing this? It's not just a flyer, not just a Facebook ad saying, I'm going to get you X return. It's like, let's look at the people, let's look at the results in the past, and let's look who's doing it. So why self-storage? So I wanted to present this to everyone. I wanted to show everyone why I personally have done the pivot. And now here's where the opportunity is. So whenever I say self-storage, when I'm in various groups, so I'm in a number of peer groups in the States with high-end entrepreneurs. I'm in peer groups in Canada with high-end entrepreneurs. When I say self-storage, eyes light up. There is a sexiness to self-storage. People are excited about the self-storage space. There are people that have made hundreds on hundreds to billions of dollars doing self-storage. And a lot of that has been the development in the States, not in Canada, but actually in the States. And this is where the opportunity is in Canada. And when we look at Toronto, but not even just Toronto, across Canada, you have shrinking sizes of spaces. This is where the residential component comes in. And when we talk about all the condo development that's come into play, people still need to put their stuff places. Also, expanding offices and retail footprints, and that space is very expensive. It's a lot cheaper to use it in self-storage. Whenever I go to my self-storage units, I see companies that are in there as well, and they got their self-storage units. They're storing things in there. They're going to their self-storage spaces. And also, traffic is so bad, it's more efficient for me to have a self-storage space close to somewhere where I have to access frequently than having it in a far distance away. And that's one of the key things in regards to self-storage development. What is it? 1 to 2 kilometers away from that's the space that someone travels to get to their self-storage
Yeah,
unit.
there's a few metrics like the industry will tell you there's kind of like a 5 kilometer radius around a site. That's pretty much your core trading area. I'll tell you from the sites that we operate and even the ones that we don't operate because we see data on a bunch of others, just through our relationship with Apple. Like I've really been amazed. Like in the sites that we own and operate right now, like upwards of 90% are literally coming within like 1 to 1.5 kilometers from the actual site itself. So again, like we all know real estate, we've all heard obviously how location specific real estate can be. Like self-storage is no different. Yes, there are pockets in major markets like Toronto, for example, I have no problem saying it, that are overbuilt, or will be overbuilt based on what's in the pipeline, what's set to come online. The good news is there's a whole host of pockets that are not.
Yeah.
And it's obviously on that latter point that we're trying to kind of turn over rocks and continue to get sites under contract and move through the entitlement process.
And that's where you're looking at high returns compared to residential, 15 to 20% internal rate of returns on these, with an anticipated exit of 6 years from initial fund
Yep.
creation. And you're going to see it's a lot like pre-construction, how this
Yep.
is structured. And I'll show you that soon. And in Canada, and this is where the opportunity is. So Canada, it's 2 to 3 square feet per person for density versus 7 to 8 in many US cities. That's the upside. Like
Yep.
we're severely, severely underbuilt in regards to self-storage capacity in Canada versus the US. So that's where you're able to look at going, okay, well, in the US, I got 7 to 8 and we got 2 to 3. And when the people that made a fortune in self-storage real estate and they were investing in when it was 2 to 3 square feet per person, that's where the opportunity is. You know, we're right at the beginning of the opportunity in self-storage. And that's the exciting part of it right now. There is such a good runway for this. And it's something where, yeah, as I said, there are some pockets that are overbuilt, but there are so many opportunities and sites and that you can build and then have an exit strategy and then have institutional money come in and build that. And Tyler hinted on it. Institutional money wants boring returns. You know what does not provide a boring return right now? The stock market. Stock market is a very, very scary return. And why I say scary return is yes, stock market is at all-time highs, but it's not predictable. And pension funds require predictable returns. That's what they want, predictable cash flow, stable returns. And that's what self-storage has to offer. So what's the process? So whenever I jump into things and people that have know me and that invested in me for a long time, I always put my money in it first before I talk to it about other people. So what I found, the whole process is similar to pre-construction investing. So the investment was structured with 5 capital calls over a 2.5 year period, which by the way is way more spread out than pre-construction investing. So from September 2022 to February 2025, I had five $50,000 cash calls, and that allowed me to that was my $250,000 commitment to be spread out over time. So when you invest in these, you make a commitment going, I'm going to invest X number of dollars, but they don't take the check right away. It's okay, as the capital is required, we're going to make capital calls for those amounts. Very similar to pre-construction. Pre-construction, you sign a contract. I have 4 to 5 dates I'm writing the amounts on, and then I'm giving the developer my checks, and then they cash the checks on those days. So a fairly predictable process to the capital that comes out. So again, your capital doesn't need to be all, you don't need to have all the capital up front. You can have invested in other areas, but you're going to have various capital calls throughout this process. And my return of capital has begun. So just fortunate timing in regards to getting involved with this, I got my first return of capital. So my first return of capital began this month, and I got a $25,000 disbursement. So my remaining capital in the fund is 225,000. So what time have you ever invested in pre-construction real estate and then the builder has given you money back? No, they're just taking more money on closing. They're asking for well, taxes, right? Like, so we got land transfer tax, we got development charges, we have hookup charges, we have all these various things that the builder asks for on final closing. Not when you invest like this, they start giving you your money back. And then there's the exit of the asset, which is either through a refinance or sell the asset by 5 to 6 years with an annual IRR of 20%. So you have this beautifully structured process that doesn't have any of the stress of investing in pre-construction real estate that I've had. And hey, I've had a good run in pre-construction real estate, made good money. Tyler has made good money in pre-construction real estate. Those days are over, and those days aren't coming back for at least 5 years. For at least 5 years, if ever, how we invested in pre-construction real estate before making the returns that we made. But it's not coming back anytime soon. And there's a history of the success. So they built before. So this is a completed development of roughly a $15 million development in London. And I assume, Tyler, the meeting is for the juice on this site after this call.
It
So
is. Yeah.
so for example, they invested in the site. I'm part of the fund that invested in the site, and they picked a site which had future upside. So the returns that the 20% IRR that they gave on this didn't even include the extra land that they can redevelop on this. And this is where Tyler's development opportunity cap comes into play. They're looking for the best sites. They're not, and I've known Tyler since first year university. Well, second year, because you transfer back in. Second year university. Um, he is not someone that is going to just take some any site and build because he has to build. So you have builders out there that will take money and they build because they have to build because they raised a fund. Okay. the opportunities that they look for, they're looking for the absolute best opportunities. And whereas, okay, we're looking to make this return, but if there's juice on this, and what I'm saying juice is like, can we make extra on this? Let's make extra because let's look like rock stars to our investors and make our investors money. Tyler isn't driven by making himself the most money. He wants to make money, don't get me wrong. But again, dealing with him for over 20 years, he uses the word, I'm the steward of your capital. I'm the steward of your capital. And he fights for every single penny. Um, Tyler, why don't you just tell the story about where the contractor tried to screw you over on the windows in London? Remember
Oh,
the
like
window frames?
there's just there's so many stories. Like I won't even go into the details of that. Like just the reality is why I fight for every dollar and why I act and why I continue to act as a steward of our investors' capital is because just again, to be blunt, the blunt reality is my capital is right beside my investors' capital. I view their capital no different than my capital. So, whether it's it sounds crazy, but whether it's $100 line item or a $5 million line item, like it's going to receive the exact same amount of scrutiny no matter what, just because we are that anal when it comes to managing obviously expenses and at the same time maximizing opportunities. This is a site, using this example, this is a site where most people said there's no feasible scenario in which the excess lands in this site would be developed or be able to be developed because it was currently a protected tree zone. What I've learned, and again, like none of this may be new to certain people on this call, but like you just don't take no for an answer. Just because the city tells you no, or just because a planner tells you no, you can't do this, does not mean no is the final answer. It just means you're not going to get your answer today, but you have to go back to the drawing board and it might involve working with consultants or commissioning another study. But when somebody tells me no, it's just not yet. I'm going to get it eventually, usually, because usually I've done enough diligence to give me a level of comfort that we can get it. It just means not yet, but Alex touched on it, the meeting at 1 o'clock. It is to unlock the untapped potential on this site. And it's an additional 2 acres of land that we firmly believe will get another 30,000 square feet of storage, which probably will come with an enterprise value of $8 to $10 million of extra upside. That again was not modeled because we weren't certain it could be unlocked, but Alex touched on it. It's kind of the cherry on top for that development. This other one that Alex had just brought up in the spirit of time, this is our Barrie facility. So Barrie's a wonderful market right now for storage. It's got very very attractive rental rates. It's got rates approaching $30 a square foot. Again, high level rental rates of $30 a square foot, hard costs of 125. You don't need a calculator to know it's a pretty attractive return profile. This facility broke ground in early February, I think, this year. And
In
we'll actually
February.
be opening this in November of this year. So again, we're getting better. I don't think we can ever really beat this timeline, but to have these built anywhere in under a year or even at a year is, in my eyes, best in class. And we'll certainly be bringing this development online in November. This facility right now, as per the picture, that's when the superstructure got completed, but it's fully enclosed now. Lockers are going in as we speak. It's going to be 126,000 square foot facility that will deliver about 85,000 net rentable square feet and should have a value, or we expect will have a value of around 33 to 35 million when all said and done. So very optimistic about this one, and it should be a good asset for the fund.
And then there's 80 million in future developments as well with sites that have been secured. But what I'm going to do is we can there's the Q&A and I want a little more to go over. So I don't think if we have time, maybe I'll dip into one, but I want to talk a little more about the process and answer people's questions as well while I have Tyler on here. So just going over the return, the way this typically works is that you're providing your committed capital over a 1 to 3 year term. As Tyler said, they're getting better at it, so that can go down to 1 to 2 years, and then that actually means the sooner they build these, the sooner you start getting your money back. Because once the committed capital begins to be returned after the development site is complete and becomes operational. When they start having money come in, and they reach a certain cash flow point on that, then they can start giving you your money back, which I've already experienced. And then in 5 to 6 years, once they reach a 90% occupancy, so it typically takes about 2 years to get these to a 90% occupancy level. That's when you can see, okay, now we have a running cash flow on the property. Are we going to refinance it, right? Refinance that, go to another commercial mortgage on this? Are we going to sell it to an institutional investor? Then you can start to begin to see a return of capital on these. But as they get better at doing these, the flow of this money becomes faster and faster and faster. And this is where Greg's investment mind comes in. The faster he can turn over money, the more returns that could be made to investors. And that's the key. And again, he was trained by Schwartz, who Onyx is one of the largest. No, it is the largest investment banking company in Canada. They own WestJet now. His wife is Heather Reisman, sorry, owns Indigo. So many things that they've invested in. This is how the people that come from Onyx are the smartest of the smart investment bankers. That's just frankly what it is. But they're also trained with an an entrepreneurial mind, because they're not working for the banks. They're working for, in essence, an entrepreneurial company. So that's where the key is. You have an entrepreneurial investment banker, very rare out there. And that's who you have working on your team.
That's well said. Yeah, you did a good job characterizing it.
And this, given exit examples. So we've seen this already. QuadReal, which is one of Canada's largest pension funds. Well, not QuadReal. QuadReal is the company. It's owned by one of the largest pension funds, British Columbia Investment Management Corporation, which invests the public assets, public pension funds of BC workers, worth 94 billion, and BCI is worth 233 billion. They just bought 500 million worth of self-storage units when they bought Maple Leaf Self-Storage. This just happened in this environment, in this market, in this world of uncertainty, and this was the largest self-storage deal ever in Canada. Just showing
just for further context,
go ahead.
This slide could be updated. Just for further context, the $500 million number looks big, sounds big, is big. I know for a fact now, because it wasn't publicly disclosed. It's still not officially publicly disclosed, but I have no problem saying this. That purchase price was actually closer to 900 million. So it almost pierced $1 billion for the Maple Leaf portfolio. So, yes, these assets were, for the most part, Gold A, Class A, gold-plated institutional type assets. Again, to be clear, those are the types of assets that we have built. Those are the types of assets that we will continue to build, because those are the types of assets that attract institutional capital. But clearly, we and anybody else in the space was very, very excited to obviously see this transaction move forward at valuations that certainly superseded anything that we're baking into our investment thesis. So, more than anything, it was just, if I really stripped it down, more than anything, it's just a reminder to us that we're on a good path, that we're in a good asset class, and there's a lot of low cost types of capital, again, institutional long-term capital, that is chasing this asset class. And we know what they want, and obviously it's our job and our opportunity to begin to fulfill that demand. So
I want to highlight the investment criteria. So to invest in things like this, there are some criteria that you have to meet. This type of investment class, your income criteria, you have to either make 200,000, or your household income with your spouse has to be 300,000. That's not our requirement. This is the government's requirement when you invest in these style assets. Or you have to have financial assets, excluding your primary residence, of worth $1 million, a net $1 million, or you have to have net assets of $5 million. But again, let's say, for example, if you had equity of $1 million in your condo portfolio or real estate portfolio after mortgages, this kind of thing, you can invest in this. Or again, if you make $200,000, or if you and your wife make $150,000, then you qualify to invest in these assets. the government puts these rules in place to protect investors. That's what it is, and that's why it's in place. So I just want to let people know that's the requirements to invest in things like this at this time. Um, though, so that everyone knows that. So
I don't
um,
know. Again, like I'm not going to go down a OSC workshop right now, but I do know as part of the accredited investor exemptions. Again, full disclosure, everybody who's on this call right now, I don't know. I can't see any names. I can't see any faces, so I'm not sure exactly who's on this call. But I will note, there is another exemption that falls under accredited investors, essentially family and friends as well. So if there is a pre-existing relationship with Alex, as an example, you likely in the event you don't meet one of the criteria that Alex just flagged, you likely still could qualify. But again, that's the extent of which I will comment on that. But
yeah.
you usually have no ability qualifying, assuming that was a pre-existing relationship.
Yeah, so if there is interest, reach out and we'll go into more details on those. But we wanted to be clear and candid with those, as we are, stewards of the capital, and we want to keep everything above board with everyone. So if something gets interested, send me an email. The next fund is scheduled to launch in September 2025. So now is the time to start speaking with me to see if there's interest in this type of investment. But while I have Tyler on for a few more minutes, I was going to plan to talk about development sites, but we got so excited and talked about the whole process. And this is really introductory to everyone learning how to invest in this stuff. We do have development sites locked up, but I want to answer people's questions on this. So let me just go to the Q&A box right here. I did end up getting logged out briefly when Tyler was talking, so it looks like the questions disappeared. Uh, but if you have any questions right now, I typed them in the Q&A box below, and while we got Tyler for 5 minutes, let's answer some quick questions here. Do you see the questions that you're in, Tyler, still?
I do.
Okay,
I
so
do.
yeah, so why don't you
The first one I see. Will a link of the recording be available? I will
yeah,
prepare
recording, yeah,
for
it's
it.
all fully recorded. That'll be sent out to everyone.
So second one, I see it's from anonymous. Couple questions. How does one find trustworthy deals, and how does one evaluate a deal to see if it's good? So again, without going into all the details and opening up our full underwriting model, the reality is in terms of site selection, I'll comment on that specifically. Site selection, the good news is that there's a number of tools, paid subscription tools that we subscribe to. So we know when we're looking at a prospective site, we know exactly, obviously, where the population is, where the population trend is going, but specifically, we know how many square feet of self-storage exist today, and we know also how many feet of self-storage is in the pipeline at the city level. So we have a very good lens into obviously what's there today and what's coming, and obviously those two numbers together, if it's below. I'm just going to use a number because it's the number that I usually use. If it's below 3 square feet per capita, it's usually something I get excited about. If it's below, 1 square feet per capita, I really start to get excited, and obviously anything lower, I start to make calls immediately. So, the reality is we've got a very good ability to underwrite a site from a market fundamental perspective, as well as obviously just a pure site selection criteria based on the tools and subscription tools that we have available to us. Then you obviously overlay that with, deal terms. Right now is very different negotiating deals on land than it was 2 or 3 years ago. Another element, obviously, with any development is entitlement, and specifically entitlement risk. Um, I think every deal outside of one right now that we've got in our pipeline, all the entitlement risk has been fully removed because the deals are fully conditional upon all the required entitlements being secured. You could not, for the most part, have any vendors take you seriously when you made those requests 3 or 4 years ago. You definitely can get those types of deals done now. And it's pretty much those deals that we're targeting. Because again, I like controllable outcomes. And if I can remove all the entitlement risks, I'm going to do so. Um, so I'll leave that one there. Other question comes from Franco. Why or how? Can property went down in value? Why or how can property went down in value, or I'm going to say go down in value? In short, a property's value could be diminished. Um, no different than a rental property, a residential rental property. Rental rates could fall, expenses could drive up, ultimately impacting NOI. And obviously, depending on where cap rates are at any given point in time, naturally that's going to be a lever, again, good or bad, in terms of values. Without, again, going into all the details, there's a lot of sites trading right now, at or around a four cap. We think candidly that's aggressive. We're not willing or comfortable to really bake our investment thesis around exiting in a four cap. Most of our investment thesis right now are assuming an exit cap at about 5.5, which again, based on where we're seeing things track right now in trend, we feel good about that. No mortgage required. You've got a question mark there. That's from Franco as well. So yes, there is a mortgage, like there is financing, but this similar to a lot of development deals, whether it's multifamily or self-storage, it's for the most part our own equity in first. And then after we have a sizable amount of equity in, that's when we typically put construction financing on, which takes us to stabilization of the facility. Once the facility's been stabilized, Alex alluded to it, that's typically when we then look to right size the debt package and put more conventional financing on it. And or obviously explore a sale if the go forward equity return looks frothy enough to obviously seriously explore that depending on where the market is. But we certainly do use financing for sure, both construction financing and run rate financing once stabilized.
And and
Um,
and, and I've witnessed this whole thing with the developments that I'm part of as well with them. So
so what is the economics of single storage unit? You're getting invited. So what is the economics of single unit storage unit? Generally, for most commercial properties, you are getting a 5 to 8% return in GTA. Yeah, so you are getting a 5 to 8%. So in short, we're getting high teens, 20% because we're levering these things. Our typical loan to value is 65. Maybe at times we've gone as high as 70%, but we like to use a ton of leverage. We like to use leverage, obviously, prudently. And we're underwriting and achieving usually kind of upper teens, 20% on an annualized basis. And again, those are gross returns prior to any, obviously, fees. How
it's
is the
it's
demand
it's
outlook for?
it's I'll also add it's also why you got into residential.
Yeah, yeah. And then few more, and then I got to run. But how is the demand for outlook for storage units in the coming 3 to 5 years with immigration obviously down? In short, obviously immigration getting cut back. It's not great. I've got no problem saying that. But the good thing about storage is it's incredibly, incredibly recession proof. And there's so many other drivers outside of just population that fuel demand for storage. One of them is obviously downsizing with all the baby boomers downsizing. That's key. Disaster, obviously short-term relocations. Last time I checked, disasters are only increasing, whether it be wildfires, floods, etc. Divorces is obviously driving a lot of storage use. Fortunately, divorce rates are still continuing to climb. And then at the end of the day, too, you know, this is the big thing for me. This really is an amenity now to help support the housing crisis that continues to, plague our country. The reality is, as more and more units on the residential side of things continue to get built, and obviously we all know what's going on right now. Not a lot of units are getting built, but the ones that are, and or the ones that will continue to get built, they are smaller and smaller in size. And for the most part, residential developers don't want to build storage anymore because it's costing them, call it 5, 6, 700 bucks to on a per foot basis to build storage in their res projects when it costs me 125 bucks a foot. So what I'm doing is I'm working with residential owners and I'm working with large commercial mall owners, et cetera, to say, hey, carve me off an acre or an acre and a half because I know you're going to do res. And oh, by the way, let me educate you why self-storage is such a meaningful piece of your master plan community. And let's obviously work and collaborate on it together. That narrative is being received incredibly, incredibly strong right now.
I'm going to ask you some quick fire questions that you can answer on it that I'm highlighting here. At the end, do we own property or are we simply lending?
You own
You
it.
own shares in the
Yeah,
corp. That's the key thing. So you're you're
100%.
you're an equity partner, and that's different. There are other funds that don't make you an equity partner. This is
Yeah,
a GP/LP model. You don't own property, but you own shares in the corporation that's developing the site. That's key.
correct.
Um, also, I see after returning capital investors in 5 to 6 years, do investors get monthly distributions from cash flow from the storage if it's not sold?
Short answer is we're not in the business of holding capital. So any excess capital will always be returned. And clearly we're motivated to do so, return capital as quickly as possible, because all it's going to do is increase our overall project returns, which candidly, that's our goal and that's what we want. So yeah, we're not in the business of holding cash. Any excess cash will always be distributed.
For investment amounts, I just Gilberto, I saw that. Well, you can talk to me and talk about investment amounts. What happens if a project is canceled, is the investment returned? Um, where you're taking money, it wouldn't really be possible for the project to be canceled, right, Tyler? Because you're
Yeah,
actually
yeah,
going right into
correct.
development.
Yeah,
Yeah.
we'll be moving forward. Yeah, yeah, exactly.
It's not possible to be canceled because actually when the money comes in, they're actually doing the development. Like
Yeah,
that's
but again, like for whatever it's worth, like in the event, I'm just gonna
yeah.
take a random example. In the event we raise capital for a project and that project, for whatever reason, it got expropriated at the final hour. Like clearly, all the money would be returned to dollar one, and the limited, assuming that we follow a similar structure of a GP/LP structure, the limited partnership agreement would clearly speak to all those scenarios.
And final question, given the importance of security, has an independent due diligence report been prepared for this project?
So short answer as an independent due diligence report, no. In the event we were to look at more of a public style vehicle or more of a retail style vehicle, we would be required to produce a OM, an offering memorandum. For our private equity investments, all of them, all of our funds to date, we've not had to do that. That's why we like this space. It's just a lot more cost efficient. Full transparency, though, we are looking at a more retail orientated vehicle that would allow us to potentially secure smaller check sizes, but more importantly, be secure and have the opportunity to secure registered funds, which is something we've been asked about because we think that could obviously open up some additional fundraising ability. But right now, short answer is no. We do not produce an OM.
So Mike, to further answer that question, it's something that Tyler and I talk about every day in regards to growing the scope of this. The value for everyone on this call is that somehow you've been associated with me, and this is giving you an opportunity to invest before the masses get into it. But the goal is to grow this so that the masses can get into it. But the great thing is once the masses get into it, the initial people that get in, that actually increases their rate of return. But the goal doing all this is actually bring the masses in is what it'll be. So I hope that answers the question, Mike.
So let me I do have to run
Yeah, you got
admittedly.
to go.
So I will run. Alex, you and I can circle up after this call.
Yep.
Obviously I expect there to be questions. I want questions. That's completely normal. I've got nothing but time to continue to educate and to continue to obviously, create more awareness around A, the asset class, and B, some of the projects that we've got in our pipeline. So Alex, you
Yeah,
and I can
I think
figure out.
what we'll do next. So yeah, Tyler's gonna go, but our next thing is we'll actually do because we want to because we like sharing info. We don't want to hide behind smoke and mirrors. Like
Yeah.
we have the projects to share. It'll just be another half an hour to an hour sharing those. So what we'll do is we're going to do another webinar where we're actually going to go into depth of all the different projects that are coming up because the fund's not going to start until September. So we have more time to do more webinars like this to increase due diligence. So the next webinar will be an in-depth dive in the actual projects
Yeah.
that are going to be developed that are secured and are ready to put shovels in the ground.
That all sounds good to me.
All
So
right.
I will run, but
Yeah.
thanks for
Get
obviously
going.
the opportunity, and I
Mhm.
will connect with you, Alex, shortly, and maybe some others shortly as well.
Sounds good. Okay. Thank you everyone for coming.
Yep.
If you have any questions and it's being recorded, Tyler, you can go.
Okay.
This is all fully recorded. You get a recording of this. You'll have my email. You can book calls. We can answer any questions you have on this. But it's something I'm invested in. I'm excited to grow this more for everyone. And looking forward to the next webinar and actually sharing the development sites that we have ready to start building. Okay, thanks for everyone for coming online, and we'll talk to everyone soon. Bye-bye.